All right, Fed rates went down, but mortgage rates went up. What in the hell is going on with our mortgage rates and this volatility that we have going on in our economy in our mortgage world right now? So I had to get my good friend Dave Sousa on the line today. We got him here today. Dave, welcome aboard, man. Let's talk about what's going on, man. What do you see happening? Why is this going on?
Well, thank you, Cash. Thank you. And yeah, you're absolutely right. Everybody was anticipating a drop in rates. As a matter of fact, especially with the Feds cutting rates more than the market anticipated.
Right.
And quite the opposite happened. As a matter of fact, it started on the day that the Fed made the announcement, and then it went
Yeah.
there. And as a matter of fact, as we speak right now, rates are about, I want to say about a 0.5% higher, half to
Yeah.
0.625% interest rate higher than where they were the day before the
The day
Fed
before the
actually
cut.
cut rates.
Yeah, and he cut
So,
it a half a point.
and here's a little bit of the explanation of why. In previous podcasts we've done, we've always said the Federal Reserve makes their decisions. Wall Street is reactive, but they're also always trying to stay ahead. So
Right.
while the Federal Reserve did cut rates in the same meeting that the Fed talked about cutting rates, the question and answer session was trying to figure out, okay, what about rates to come? What about cuts to come? What about cuts coming in the future? And the Fed was quite reserved on what cuts they might do in the future.
Right.
So while the immediate cut was a 0.5 point, and you actually saw that on the day that the Fed spoke, September 18th, the immediate initial reaction within the 5 to 10 minutes after the Fed started speaking was the stock market jumped up and the bond market dropped. Rates
Yeah.
dropped right
Big
there
reaction.
as we were speaking. And then towards the latter part of his conversation, as the question and answer session ensued, and it became more apparent that, okay, they've cut the 0.5 point here, there really isn't any indication of what cuts may be coming in the future, if there are any cuts coming in the future. And so Wall Street immediately did an about face, and the 0.5 point increase that you're seeing in rates since the Fed cut rates is actually Wall Street trying to predict what's going to happen between now and the end of the year with rate cuts. Does that make sense?
It does. So it also tells me that Wall Street actually has some control on what's happening, or maybe not intentionally, but what they're doing.
No, absolutely. Wall Street has complete control because
Right.
how Wall Street reacts to what the Fed does and what the Fed, and also how Wall Street anticipates what the Fed may be going to do in the future has everything to do with where prices are. And
Right.
that's why,
Yeah.
as we speak today, while the Fed cut rates a 0.5 point, our par rate as of close of business yesterday was
Yeah.
6.25% as compared with 5.625% the day before
Yeah.
the Fed cut rates.
Dave, can you kind of touch on that par rate, right? 6.25 is higher than we were at about 5.625 just the day before the cut on the 17th, right? And then everybody anticipated a 1/4 point to a 1/2 point. There was all these different polls going on, like which was it going to be, the 1/4 or the 1/2. It seemed like more people were leaning towards the 1/4 than the 1/2, but then he dropped it a 1/2 point. And it was like, yay, hooray. But then rates went right back up the very next day,
And to your point, the yay, the hooray, yeah, we saw that. We saw that for about 10 minutes after he made the announcement.
right.
And
Yeah.
then the minute the question and answer, see, whenever the Fed does a speech, he speaks for a certain amount of time. And then at a certain point when he's done speaking, the journalists get to ask questions. And there's about a 30 to 45-minute question and answer session where
Right.
questions are asked. The Wall Street Journal, Bloomberg News, et cetera, et cetera, et cetera. They all ask questions and the Fed answers. And the guts of what is going to happen and beyond that has everything to do with how he responds to the questions. Because
Right.
in his response to the questions is how the journalists are anticipating what the future reaction might be to what has happened today and what the future action of the Fed is going to be, which is going to have everything to do with how Wall Street acts now, trying to stay one step ahead. Does that
Right.
make sense?
Yeah, absolutely. Absolutely does. If you could touch on, though, because for our people that are listening out there, what a par borrower really is, actually.
Well, par rate is just for any given borrower. Think about an interest rate as a suit. People ask
Mhm.
me, well, what's the interest rate today? I said, well, what's your shoulders, what's your waist, what's your inseam, what's your chest.
Right.
It's you could have three different guys and it's different for three different people. Now,
Right.
generally speaking, when I price rates every day, I price an 800 credit score, 20% down, a regular conforming loan amount up to
Yeah.
766 in LA County. And so I'm pricing the best case scenario, vanilla 30-year fixed with good credit, full qualifying, everything.
Full
And
doc.
when I say par rate, that means not buying down the rate at all.
Not
So when
buying
I
down the
say
rate.
there's a par rate, that means you will not pay any discount points to buy the rate down.
Right.
You could
Right.
go higher than that rate and get money back. You could go lower than that rate and buy points to buy a lower rate. But
Right.
when I say par rate, that's neither buying up nor buying down. That par rate is the cost at which we get that rate from Wall Street.
Gotcha. Yeah. Super important number to look at, especially when you're looking at other lenders out there and what they're marketing, is not necessarily a par rate. Correct?
Well, and beyond that, the other thing why there might be a discrepancy is because of the size volume lender we are and because of the amount of business that I personally do, it's not unlikely that the rates that we have that we're able to offer clients are typically anywhere from an eighth to a quarter and sometimes even higher than that, more
Right.
than that, better than what the standard market rate is. So if you're out there looking at a 6.5, 6.625, it's not uncommon at all that our par rate would be 6.125 or 6.25, as is the
Right.
case right now.
And you actually have a really good rate going on at 6.25 now. Is that right?
At par,
Today's
yes.
rate? At par. I'm
And
also seeing a lot of them push out there the average at a 6.65 right now out there in the market too for 30 year. So if you can get a par rate, that's definitely what you want to do. But since these rates have gone back up, I understand. Tell me if I'm right or wrong. That there's been about a 5.1% reduction in mortgage applications as a result of these interest rates going up again. Right? What's the thought on
well,
that?
I don't know what the exact percentage is, but I can tell you from my own personal experience in dealing with several clients on a daily basis, a lot of people, when there were people that were waiting for the Fed decision to say, okay, now I'm going to refi.
Right.
And when it happened, a lot of those people were disillusioned because what was expected is different than what actually happened. And so I have had quite a few people that have said, look, even if we start it now, Dave, I think we want to kind of wait. As a matter of fact, just this morning when I checked my emails, there was 3 emails in there from 3 different clients saying, yeah, we definitely want to do this, but I think we're going to wait a little bit and see if they get back to where they were or maybe better.
Right.
And so case in point, hindsight being 2020 and human nature naturally being greed, if people look back at it, a lot of people, when I was at the 5.625 rate, people were thinking, no, I want to wait because it's going to get better. What happened? They waited and it got worse. So in hindsight now, what are they thinking? Damn it, I should have taken that 5.625 when I had.
Right.
But hindsight's always 2020, isn't it?
Yeah, it is, and regardless of how the markets are acting with the interest rates right now and our prices going up or going down, here's my answer to that across the nation. It's choppy. As I said last time we chatted, I feel it's still about the same. It's a choppy market, meaning that I don't really see prices going up. I don't really see them going down. Some areas are different. They're reacting different if they're different parts of the country. But what I am seeing is more just kind of stable numbers, really, at the end of the day. You have seen price drops, but a lot of that is because the owners of the property have just been overpricing the property. They're still stuck with that seller's market that we had, which we are not in anymore. We're barely in a seller's market in the LA, California area, going more neutral, really, at the end of the day, more normal, if you will, right? So inventory has picked up. It has increased. And then rates were coming down, so our demand was picking up. So it's all about that supply and demand. That we got to always look at what's going on, right?
To the point that you're making right now, it's an interesting and certainly adds to the complexity that, ironically, Wall Street is always pricing ahead. So they're like a little jump ahead. And the sellers of the real estate market is in a little bit of a lag. So if you've got one part of the equation that's jumping a little ahead, and then a reactive part of the equation that's falling a little bit behind because of a lag in assessment, that means you've got even twice that gap, right?
Right.
Between where rates are pricing and where sellers are. So, but this is the way the historical trend has been. My hope is, while we continue to see a longer term leveling off and improvement of interest rates, that we see sellers start to let go of the real estate market of the past and embrace the real estate market and the inventory situation of the
Right.
present.
Right.
And as you and I have discussed before, from a seller's perspective, my personal belief is the price that they're going to get today is better than the price they're going to get 3-6 months from now when interest rates have improved and there's a higher inventory. And I know there are two schools of thought on that. You and I have discussed that, but my personal view is, and I'm still holding on to this, is as we see rates improve, as rates continue to improve, you're going to see a lot of people that I affectionately refer to as interest rate prisoners in their home.
Correct.
Come back, put their homes on the market, and
I agree with that.
we went back to that. Where this is all going to play out is how is the battle between supply and demand going to play out?
Right, 100%.
If as the supply increases and the demand doesn't increase proportionately, prices are going to go down.
Exactly.
If the supply increases and the demand increases proportionately or greater, prices can stay where they are, may even go up.
Right.
And it's a very simple concept that goes back to caveman days.
It does.
Supply and demand. Supply and demand. It's all about supply and demand and that balance between supply and demand. This whole issue we're looking at right now with inflation, supply and demand. This whole situation we're looking at with jobs, job growth, job loss, unemployment, supply and demand.
Correct.
The need for new jobs, the number of new jobs there are. The number, the new job openings, the number of people that want to take those jobs. Everything comes down to a very simple balance of supply and demand. And when that balance is out of whack, then when things are more in the favor of supply and there's less of a supply, the inclination is for prices to go up. When on the other hand, there's an overabundance of supply and a sort of a recession of demand, that's a clear indication that prices will come down.
So all of that said, Dave, my thought is that with the supply and demand, I totally agree with that 100%, but I feel that because there's been a lot of sellers with this interest rate fatigue, or prisoners, if you will, they've been waiting for rates to come down on the other end, because if they sell, they're going to buy. They don't want to buy it north of 7% on a rate. They want to get something that we're starting to get a little closer to that number that might get the needle moving, right? And it was getting there. Yeah, as we talked about, we
were about a half a point off of that. Yeah.
That's it. Yeah, where the needle really would have started moving. More sellers coming on the market.
Now we're about I'd say closer to a 1% off of that right now.
Just about, yeah, it's about right. Yeah. So with more sellers coming on the market, that brings more inventory, because the inventory has picked up regardless, but it still has a long way to go before we get into anything close to buyer territory. We're still hovering around 2 maybe to 3 months of inventory across the nation, right?
So you're saying still, regardless of the fact that there's been an improvement,
right,
their inventory is still lower than it should be.
Correct. We're not at those levels of where we're like getting close to being a buyer's market. That's going to be more like somewhere right around a 5.5 to 6 months supply of inventory. Okay. And what that means is if no more homes came in the market at all, that's how long it would take to rid that inventory. 5.5 to 6 months to sell all of that standing inventory. That's what they mean by that. So right now we're looking around, I'm in 3 different markets myself, Las Vegas, Nevada, the Boise, Idaho, Treasure Valley, Idaho area. I'm licensed in selling real estate there as well as Santa Clarita, California. And I'm communicating and doing deals in all of these states all at the same time, and also masterminding with agents across the country. So we're talking about what's going on in all these different states and regions of the country. And it's super informative to get that collection of data from people in real time that are in the trenches, that are working in the trenches. This is what they do, right? So they're not reading
you're feeling that while inventory is improving, you feel more like the demand might be stronger than the inventory, so that may not necessarily have prices go down.
The only reason I think that is because we're supplying more options for buyers that some have stepped out of the market because they just couldn't find what they were looking for. Now they're realizing there's more inventory coming on the market. We have more things to look at. We might be able to find something that we want to go forward on and maybe pay a higher interest rate and buy this property, right? So there's that piece there. The other piece is that we have more sellers that'll be coming on the market too to provide that inventory. But then that's also going to provide a buyer as well. Yes, they're going to be another house on the market, but they're also going to go and buy something else. Typically, not all the time, but this is what we typically see, right? So that's where my thought lies with those elements, and why I see with rates coming down a little bit more next year, which is what Realtor.com is calling for too. Realtor.com is calling for low sixes through the rest of this year, and maybe getting into the high fives in 2025.
Well, and that's the beauty of dialogue and a podcast like this, where it's even in this last example, we've got two slightly opposing views of what the direction may be, which is fantastic, because
Right.
you could be right, I could be right, or we could both be slightly right or slightly wrong. At the end of the day, the factual nature of it is, whether you're leaning what in your train of thought or mine, the balance between supply and demand, or the imbalance between supply and demand, is what's ultimately going to determine what prices end up doing.
Well, absolutely, and trickle
regardless of which way they go.
And trickle in a little consumer confidence into that equation, because that's going to improve the demand, right? The interest rates are going to help with the demand. It's going to be indicative of that. And of course, throw in a little consumer confidence. People start feeling more comfortable about spending their money and going forward these large purchases. That's going to help as well. So, and 2025, I mean, listen, I'm going to throw an asterisk up here, Dave, right? Because the way the world and the economy's been lately, who knows? Really, it's really hard to put your foot down or your fist down on that and say, this is what's going to happen. I'm going to say this is very possible what could happen, but it's also very possible that it could go the other way too. So,
well, there's an interesting segue here. You mentioned consumer confidence, and there is a gauge. We talked about this last time, but there are three gauges that the Fed looks at.
Right.
Two of them, well, the first is CPI, Consumer Price Index, which is basically what people are paying for goods, the prices people are paying. There's the PPI, Producers Price Index, which is what it's costing to produce these particular items. And
Right.
last but not least, and this third one, which is the Fed's favorite gauge, is actually tied very closely into what you just referenced, which is consumer confidence. And that is the PCE, Personal Consumption Expenditures. What
Right.
are households spending for gasoline, for utilities, for groceries, for shelter, for whatever they're spending for? What is it? And this third gauge is actually the Fed's preferred gauge. And if you think about it, tying into what you said about consumer confidence, if people are confident about the economy, what are they going to do? Spend more.
Money.
So if consumer confidence is up,
Yeah.
the personal consuming expenditures, personal consumption expenditures, the PCE index should be up. But if consumer sentiment is not up, if consumer sentiment is soft or down, then that should translate to a lower PCE. Because people are not going to spend more money if they're less confident in the economy.
Exactly. That's
consumer sentiment is something that the Fed certainly takes into consideration, but the quantifiable data that the Fed uses, which is a direct reflection of consumer sentiment,
right,
is the PCE, Personal Consumption Expenditures, which is what are households actually spending to stay afloat.
Right.
Sorry,
yes.
I didn't mean to go off on that, but it was
that's
tied into
okay.
what we were talking about.
We're used to that with you, Dave, and we appreciate that because we learn a couple things along the way.
Well, and it's specific to what you were talking about, consumer sentiment. You hear the word bandied about all the time, but it's very, very, very important. Because
100%.
You know, how, as an example, how you and your family feel about the economy and where it may be heading has everything to do with yours and my livelihood. And it has a lot to do with how much are you going to spend on things you want to buy. You want to buy a car, you need to buy gas, you need to eat, you need to go out, you need to buy groceries, how much groceries you're going to buy, all this kind of stuff. It's all tied into how do you feel about the general economy?
100%. That's probably one of the most important elements or factors in people going forward with a purchase. Yes, the interest rate is very helpful, but if they don't feel good about going forward for whatever that reason is, they're not going to do it. They got to feel good. Listen, I've been in sales my whole life. If somebody's starting to squander and just not feel confident going forward, they're not going to do it. And you don't want to pressure anybody to do that. You don't want to get somebody involved in buying a house and you just feeling like they really don't want this, or they don't feel confident for whatever the reason is, why go there? Because we're going to get into escrow and it's probably going to fall apart. And that does my seller no good, or the buyers no good, and the escrow people and the lenders and all the people, the home inspectors, the title companies, everybody that's involved. One home selling stimulates so many jobs across the board. I've got to count them all up. I don't even know. It's a lot. Let's go with
Right.
that, right?
And my personal spin or spin off on
Oh,
consumer
here comes little
sentiment
Dave
is
spin. Dun, dun, dun. What do you got, pal?
Dave's spin off on on consumer sentiment is, what is the sentiment they're talking about? When you're saying I'm optimistic about the economy, what are you really saying? I'm optimistic about how much money I'm going to make in the future. If
Right,
the economy is good and you're thinking, well, the economy is good, so whether you're self-employed or W-2 employed, if the economy is good, you have job security. Or if you're self-employed, you have the opportunity to make more money. So I'm
right,
confident, hey, I don't mind going out and spending a little because the economy is doing well and I think I'm going to make more money.
right.
But if consumer sentiment is down, the economy
Correct.
is not doing so well, I'm not sure I'm going to make so much money. I'm not sure I'll have my job next month.
Right.
That is my interpretation of taking the word consumer sentiment and looking at what does it really mean. And when I
Right.
hear the word consumer sentiment, I'm thinking about, how do consumers feel
Yes.
about the
Yes.
economy, but more importantly, how is it going to affect their ability to earn and in turn spend in the future?
100%. And today you have to be so vigilant. You have to be very smart and aware of what's going on and being able to decipher what's true, what's real, what's not. Because of the media out there, they have agendas they want to push, whatever direction. I'm not going to get political with this whole thing, but whatever direction they want to push, right, left, up, down, sideways, whatever it is, they have tremendous power on people. And then there's that herd factor too that comes into play, where people start going, oh, you're hearing this and you're believing this, and now you're reacting in this way and that way. And then it seems like the ball gets rolling, the momentum builds up, right? And then we start having that effect. So, like
Well,
I said, go ahead.
to your point, as human beings, we had a little sidebar about this before we went on the air, but human beings, unfortunately, the majority of human beings are drawn to drama. And because human beings are drawn to drama, how do news stations and media make their money? They make it from advertising.
And fear.
How do they get people to watch more?
Right.
They take something that's about this big and they make it seem this big.
They throw
And
more
so the
hopes
more
and sugar
drama that the media can create, God love them,
yeah.
the more drama they can create, the more they have people focused in. And
Right.
so unfortunately, a lot of times what media does is, rather than just administering the facts, they add a lot of flavor to it. They add a lot of drama to it, because that is what will hook people.
Yep.
And so when all that drama gets done in, then that even causes people to even further react.
Right.
So, and this is not something that's new. This is something that's been there for God knows
Forever.
how long. Every day, as an example, I watch on one of the tabs I watch when the market closes, and they'll say, "Oh, so and so company had a huge drop in shares today," and you actually look at the number, and it was 3.6%.
Right. But that's big news.
3.6% isn't huge.
Yeah.
It's 3.6%. But the
Right.
caption at the top to get people to click is, "There's a huge drop in it today." And then they
Right.
won't finish it, so they have to click. So the whole idea of dramatization of the news, dramatization of the data,
Correct. They're
it,
selling.
it, it
It's
converts to money.
sales.
It
Some
converts
of the
to
best sales
ratings. It
people out there in the
converts to
world.
money. And so here we are.
Right. It's like this bottle of Pellegrino. You could say, hey, it's a bottle of Pellegrino. Or you can say, oh my God, look at this. It's like a great bottle of Pellegrino.
Or better
Now,
yet, this is the last bottle of Pellegrino you're ever going to see.
Yes, the best. Yeah, exactly. 100%. And then there's the scarcity factor. Well, it's the only one left today. Wow.
Mm-hmm.
Now I got to get that thing right away. Right. So we have that that plays in everything too. But yeah, it's really a science. It's so interesting, being in real estate and in you with the lending end of things and all things financial that gets involved in that. Like you said, we have different clients, a lot of hardworking people that just want to get those first homes, right, and start building wealth, or maybe a couple investment
Right.
properties.
Yes.
Or you got the highly affluent people that they're trying to find ways to avoid taxes, right? We talked about that earlier, and there's just so many different strategies that can be employed by all these different groups and demographics of people that it's amazing when you start to it opens your eyes to a lot of things when you start really getting into that. Real estate's just been a wonderful world and educational in so many ways. Again, um, you know, with the mortgage and financial world as well, right?
Well, and I think now more than ever, um, being not just asking for business, but being a resource in the way that I hope that I am to you and our clients,
Right,
in the way that I know you are to
right,
your clients and our clients.
right. That's what we're
Being a
here for.
resource, especially now with all the drama, with all the misinformation, especially in the transitional nature of where we are,
Yeah,
being a resource like your doctor, like your lawyer, like your CPA, like your financial planner, being a resource is critical. And I think one of the reasons that one of the things that defines mine and your success, and all the rest of us who are successful in this industry, is by being a resource, not just asking for the business, but
right.
providing data,
Yeah,
providing information, being a resource that people can look to and say, hey, this guy's definitely not as dumb as he looks. Let's listen to
right,
what he
exactly.
has to say.
Right,
And you build relationship that way.
a hundred
It's not
percent.
necessarily price.
Right.
Yes, it's service, but part of service is being a resource.
Dave, I agree with that 100%. I don't know where I developed this thought and opinion. Maybe it's from reading some different books or listening to some of the lectures or some of the mastermind groups, whatever it was. But collectively, brought me to this profound opinion about sales, right? When we're meeting a new client, yourself or me, and I know you're the same way, the same philosophies, is that we're not trying to sell you anything. We're trying to solve a problem that you have. The problem of maybe it's you want to buy a house, maybe that you're in a price point that's really tough. There's a lot of competition. Whatever the case might be, I'm here to solve the problems for
Yes.
you
It's
and
a, it's
help
a
you,
combination of solving a problem and fulfilling a need.
helping you acquire what you're looking for. And there's going to be multiple things that we're going to solve along the way. And when it comes to listing a property, it's the same thing. Am I listing your property to sell you something? Yes, at the end of the day, true, but we're solving the problem is what we're really, really doing, is helping you solve that problem, get your home sold, of course, for the most money possible that we could possibly do, and get you successfully make that transition into the new home or the new state that you might be moving to or wherever, new job, whatever it might be. We want to help you with that. And it really requires, like you said, people that can connect you with the right kind of people, and have the answers for you and answers based on experience, not just something you've read or took a class on, but you've actually had multiple experiences with the dynamic that you can share with people and help educate them and give them the information so they can make the right decision going forward, right? That's how I see it. What do you think, Dave?
Well, and that ties into exactly what I said. When I say resource, I mean providing our clients the information and the tools and the data
Right.
and the options and all of the intel that they need to make an educated decision on what's best for them.
Absolutely agree. That's why we work well together. Listen, I want to kind of get into another little quick area real quick. As far as, well, first I want to talk to people about this. Areas with the highest percentage of homes with mortgages. Interesting. I've got a graph I'm going to send out to a lot of people in my database, but if you want to look at this more seriously, let me know and I'll make sure we get that to you as well. But the areas with the highest amount of or highest percentage of homes that have a mortgage, very interesting, right? Washington, D.C., 74.7% of homes owned there have a mortgage. Super interesting when I read
So
this,
about
right?
25% of homes are owned free and clear.
Oh, exactly. No mortgage. So great place to be doing lending in Washington, Dave, right? Everybody's getting a mortgage over there. Areas with the lowest mortgages was very, I was like, really? You got to be kidding me. I didn't believe this, but this is what they're saying. With the lowest amount of mortgages, meaning the home ownership
The
mortgage
highest
free is
amount of
higher.
owning free and clear.
Right. 45% have mortgages. That's it in New Orleans or Narlands, however you want to say it, right? 45% of homes
So
have a mortgage.
55% of people that own homes in New Orleans own
No,
them
I'm
free and
sorry. I'm
clear with
sorry. I
no
got that
mortgage.
backwards. My apologies. Beep. Let me correct that. Edit. 45% of these homes have no mortgage.
Okay, so
45% have no mortgage.
45% of homes. So almost half the homes
Correct.
in New Orleans are owned free and clear.
This is what I'm reading in the statistics that I was reading, and I'm going to share that with people if they want that. And the other interesting statistic, which has been for a while, I've been talking about this on some of the other podcasts, is that um, the percentage of complete home ownership nationwide is, I believe, it's historically highest right now at 39% of homes out there are owned mortgage free. Almost 40%
This
of
is
homes have no
nationwide.
mortgage nationwide.
Can I ask you, do you have a statistic for, since we do business in largely Southern California, do you have a statistic for the Southern California, Los Angeles County area on that as to what percentage of homes, because like as an example, Southern California and
Right.
especially Greater Los Angeles is a slightly more expensive price range, right?
I want to throw it out there that was around six. I'm going to look again. I don't have it right in front of me, but I want to say it was around 67% of homes. Maybe Amy remembered it was about
So you're
67%.
saying approximately 1 out of 3 homes in Southern California, the Greater Los Angeles area, is owned free and clear.
Correct.
Wow,
Correct. Yeah.
that's higher
So
than I thought it
let
might
me
be.
verify that. I need to verify that, but based on my memory from earlier, which I had a lot of stuff thrown at me this morning, I can only absorb so much in one day with only one cup of coffee.
Understood. We maybe we can clarify that on the next podcast.
Yeah. Yeah. So
Because I'm
anybody out
sure
there
that's an
listening,
interesting specific statistic, especially since you and I do a lot of business here.
right.
People that are our audience here might want to know, hey, what percentage of people actually own homes free and clear in the Greater Los Angeles, Southern
Right.
California area versus those that have mortgages?
I was very close. Yep.
So
Let's
approximately
say 66.
32% are free and clear. No mortgage at all.
Memory's working pretty good there.
Excellent.
Yeah.
That's certainly higher than I thought it was. I would have thought that because it's a higher priced area, there would be a lot more homes with mortgage. But interestingly enough, so about 32% of homes in the greater LA area are owned free and clear. That's not bad. That's almost 1 out of 3.
Another thing I wanted to touch on real quick was, and I wanted to ask you about how you're seeing um, people borrowing money or doing HELOCs, home equity lines of credit, so they can pull money out and do remodels and stay at their house. Are you seeing much of that? I know the rates are higher still, but what are you seeing in those kind of numbers?
Oh yeah, I would say in the last year and a half to 2, I have done more home equity lines of credit in the last 18 months than I have my entire previous 30 years in the industry.
Really, in the last, I'm sorry, Dave, how long?
Well, I've been in this business for 32 years,
Right.
and I have done more home equity lines of credit, either HELOCs or second trust deeds, in the last 18 months than all of my previous 30 plus years in this industry.
Really?
Yep.
Well, let me ask you, did you used to do HELOCs before, or is this a new thing for you?
Oh no, as long as HELOCs have been around, it's been possible. But
Okay.
the discrepancy between where interest rates are and where they were has never been greater. Understand, we just came out of about 2 to 2.5, 3 years, between 2 and 3 years ago, we came out of a 2.5 to 3.5% interest rate environment.
Lowest in
That is the
history.
lowest in history.
Yeah, lowest in history.
So the probability of a gap, and then we went from there to somewhere in the 7.5 to 8 range. And now we're down back, let's say, closer to 6%. But
Right.
nonetheless, when you've got people, anybody who could refinance, anybody who was able to refinance,
Right.
jumped into that 2.5 to 3%. So out of that odd 66, 67, 68% of people that do have mortgages, according
Right.
to the statistic we were just talking about, I'm sure that the majority of those people are in the 2.5 to 3.5 to maybe somewhere between 2.5 to 4% rate range. So
Gotcha.
naturally, if they want to borrow equity out of their house, they're not going to touch that 2.5 to 4% when rates are in the 6.5 to 7.5 range. They're going to do equity lines. So the equity loan environment, the home equity loan market has skyrocketed in the last 18 to 24 months.
Yeah,
More
that's
so in the
pretty.
last 18 months. Now,
That's
what you're
super
going to see
interesting.
is as rates come down and you can get first trust deed mortgages closer to the 5.5 range, you're going to see a lot of those equity loans get refinanced and paid off and consolidated
Okay.
into a first
Gotcha.
trust deed mortgage. Because if you have a first trust deed that's, let's say, at 3.5%, and
Mm-hmm.
an equity line that's at 8.5%,
Right.
you combine those two, you may just be better off with a 5% straight, depending on how much you owe on each of those dollar amounts, right?
Okay. Yeah.
So it gets a little complex from there, but as rates continue to improve, you will see less home equity lines of credit and more people that are actually refinancing the first trust deeds, doing cash out and pulling cash out there instead of accessing their equity through a home equity line of credit.
I was talking to Amy earlier about this, about renovation remorse. Here's another catchword we could throw into this whole with interest rate fatigue and all these kind of things and prisoners. Renovation remorse, because there's been a lot of people that have been renovating their homes, like you said, pulling these HELOCs out and staying put in the home, right? Because they want to keep that 299 or 279 rate they have. Let's fix this house up and beautify it and make it ours, right? I guess the number was about 74% of people doing that, wherever this poll came from, found out that there's a lot of renovation remorse for these people, that they regretted doing the improvements, or it was the type of the improvements. A couple of things I want to share with you about that is overspending, the project's taking too long, right? When you start working with contractors, especially in today's world, prepare yourself. If they might tell you to take a week or two, that could be a month or 6 or 2, right? Then invasive. People don't understand. Maybe they haven't done projects before. I'm really fortunate. My wife is like a project manager when it comes to this. She knows, and she's done a lot of these projects. She knows how to coordinate this thing. She knows how people are, their mannerisms when they come into the house. How are they going to treat your house? How are they going to treat you, your animals that might be living there? Who knows, right? All these things are super important elements. If you haven't thought about that, call me. I'll let you talk to my wife or something, because she's got a lot of amazing insight on how this all goes down. Contractors coming to your house is not the easiest thing to deal with, and especially if it's going to take a couple of weeks. If you're like replacing the floors, or you're redoing the kitchen, or you're redoing the bathroom, make sure you got one bathroom that's set aside for everybody to use something, right? You got to cook. You're living in this house. Unless you can
As
afford
you're saying this, I'm formulating a question in my mind with the analytical nature that I have. So
okay, what do you got,
the
man?
issue you presented is renovation remorse.
Uh-huh.
So might I be so bold as to ask, what might you offer is the solution to, or what are people thinking? Okay, I'm having renovation remorse. Instead of renovating, I should have
Moved.
done what?
Well, yeah.
So if that's the detail of the if that's the detail of the remorse, is the alternate solution maybe instead of doing renovations, should I have sold my home?
Not necessarily so. As a realtor, I would love to say, yes, have me over. Let's just sell the
That's
damn
what I'm
thing.
kind of asking is if
Right.
people are having remorse about having done it, or is the alternative I should have just saved my money and never done the renovation and just stayed in my house the way it was.
Right.
I'm curious what the is there a
Yeah. I
Is
got
there a
an answer for
solution
you.
to
That's
the
a great
remorse?
question. It's a great question, Dave, and I have an answer for you. I think it's both of these things. You know, sometimes making the move would have been the better choice because there's an element that remodeling and changing the floors and adding all the paints is not going to change anything. If you've got like a problem with a neighbor that you hate, or you got traffic noise coming by, you can't sleep because someone's got barking dogs, or your job has really got to move you across the city or the state, whatever it is. These are reasons you just need to move,
Yeah,
right?
and I think I was just thinking of it as, oh, sorry.
Right, right. Yes, yes. That's a great point, Amy. That now you got to look at energy efficiencies, updating and upgrading all these kind of things. And a lot of people kind of they're focused on the things that they can see, they can touch, see, and feel. I want the beautiful countertops and cabinets. I want the floor. You know, those are the biggies, right? I want the bathroom to be just. I want 10 shower heads in there and all these kind of things,
So
right?
what you're sort of saying is, if I'm a homeowner and I'm having renovation remorse, I could
Huh?
say to myself, gee, instead of having gone through that renovation, I should have what?
Well, the answer is this, Dave, because I was going to further with this is that it's not necessarily always have to move or just do that, but they don't understand when you're going to do a remodel and depending on how extensive that's going to be, there's a lot you've got to consider. As I was talking about the overspending or underspending, taking too long, too much out of your life, and just the invasive nature of contractors coming into your home. A lot of people don't take that into account or really think about how that's going to play out. So that's a good conversation to have, and I think I'd sit down and write all these notes out and
And
really.
maybe what
Yeah.
also might be a really good thing for us to offer our clients in the next podcast is, between now and then, maybe connect with a few of our clients who have gone through this process, and maybe some that do have some regrets, and say, hey, in hindsight, what would you have done differently?
Right,
And maybe
right,
that will help those that are possibly considering doing renovations that could potentially have renovation remorse.
correct.
Think about, oh, well, okay, Johnny and Mary and Joey and Brenda all went through this, and okay, well, instead of doing that, they thought maybe they could have done this.
Right,
Maybe we can offer that as options and thoughts and feedback as a discussion
right.
on the next podcast.
That's a really good point. We could do that too, and hopefully be able to get my wife Amy on because she's got tremendous insight on that. And I would have to say this to you is that if you're going to do any project, I don't care how experienced you are. If you've got a little bit of experience, that's not enough. You need a really good contractor, one that's going to oversee everything. Hire the different contractors, right? Or a project manager to be able to look out at all these things, keep everybody on schedule, keep everybody doing the things they're supposed to be doing, like laying down the plastic when they come in on your floor, taking the shoes off, whatever they're doing, putting the plastic up over the vents so you're not going to get drywall dust all over the place, which will take you the next 6 months to clean all that out. So you need somebody that's like, hey, I know what's going on here. I know construction and contractors. I know how they act. I know what they do. And I'm going to keep them all in line. I'm going to crack the whip if I have to a little bit. We're going to keep things moving smoothly because my clients need to get back to their life. And this is very intrusive and it really could change things up for people. So as long as they have that understanding and have somebody really looking out for them in that capacity, I think it makes things so much smoother. Like anything, selling your house or doing a loan, you need somebody that knows what they're doing and they can articulate that to you, the consumer, as well, so you can make the right decisions. But you know what to expect. We're future pacing for them, so they know what to expect in that transaction, right?
And maybe I could go out on a limb and say, if you have experienced renovation remorse and you have stories that you'd like to share about what you might have considered to do differently to avoid that, or to not have experienced renovation remorse, maybe reach out to Cash and tell them what exactly had happened that was not to your liking, that is causing
Right.
the remorse, and
Sure.
maybe what thoughts you might have about what you might have been able to do differently, and maybe
Right.
other clients of ours can sort of pick up some notes from this. So we would
Absolutely.
appreciate that if there's any feedback you can provide us.
Absolutely, 100%. That's a great tip, Dave. 100%. So make sure you reach out to me or Dave with any questions anytime when it comes to lending, financials, real estate, and all that entails. We're always here for you. Just reach out. You know how to get hold of us. Our information is always out there, all over the place. Really easy to find, and we're the kind of people that get back with you quickly. So I'm going to go ahead and say, Dave, let's go ahead and close this one up. Call it a wrap. So thank you, Dave, for your time and your courtesy and your information and knowledge that you share with us all, man. Really
Well,
appreciate
thank
it.
you, brother. It's always a pleasure, and always glad to be a resource, and always glad to be of service. And looking forward to the next one. Cheers.
Likewise, man. Thank you, Dave.